you should be getting two mails actually. You get one auto mail from YouTube, okay, and then you get a manual mail from me. So in case the YouTube link doesn't work, click the manual mail, the link that is there in the manual mail that you get from me. So everyone, AA, you had a problem earlier with your access. Are you able to see it now? Okay. Please make sure you check all this. Don't come to me like 2 days before the exam saying I can't see any of the videos. You're supposed to be doing your, getting ready from now itself, making sure you can access the videos. All right. Okay. So let's quickly go through the correct answers for your CP questions. Okay, as I said, very poor performance. The article, you have the article given to you, the CNBC article. I'm going to make you read, where is that article? So I think this system is mainly hanging. Okay, so this was explained just a few days ago, and yet I don't think anyone answered this correctly. Not a single person answered this correctly. So placing an order, the correct definition of spoofing will be placing an order without the intention to have it executed, okay, or without the intention to allow it to be executed. Normally you would assume that when a person places an order, he obviously intends for it to be executed. But this is specifically when actually, if you look, when they do these convictions, like when they convicted this Indian trader Narinder Sarao, how did they prove it? Because he was doing algorithmic trading. Okay, remember this is HFT. So HFT necessarily has to be done algorithmically, okay? Because a human being can't trade at such a high speed. So you can see in your algos itself the program code. When you look at the program code, you will see that the code already provides for the cancellation of the order. So it's not like, okay, I thought I would cancel the order. You have already coded it into your program that these orders will be placed, and as the price reaches near that order, they will be cancelled. Or for some other, when some other condition is met, the order will be cancelled. Is this clear? Okay. All right. So spoofing specifically is placing an order without the intention to have it executed, basically to fool the market, right? To deceive the market. And layering is just multiple cases of spoofing at at various different prices. Okay. I don't know why nobody got this right, because this was discussed just a few days ago. All right, next question. Standard financial market definition of a recession. Some of you got this right, but your answering again is not very proper. Some of you are saying economy and GDP. GDP is a specific measure of economic performance, okay? GDP growth, changes in GDP, okay? Quarter to quarter or year to year changes in GDP. That's a specific measure of economic performance. You can also look at inflation, etc. So the correct answer is the 2 consecutive quarters of GDP contraction, okay? So some people said GDP falling down and all that. That's not the way a finance student should be answering. You just say contraction, GDP contraction, or negative. We don't like to say negative growth, because negative growth is like a kind of an oxymoron, okay? Growth normally implies positive movement, okay? So therefore we use the word GDP contraction. Okay, another name for a yield curve is term structure of interest rates. This must have been discussed at least 3 or 4 times. The term structure is a standard for many cases of, is a standard expression for many cases of what type of data in finance? Terms, cross-sectional or time series? Cross-sectional, okay. Many instances of cross-sectional data in finance, they are described as term structure of this, term structure of that, etc. Okay. So nobody got this right. Amazing. Okay, in commodity markets, again, your answering is highly improper. Many of you at least remember that contango means upward sloping and backwardation means downward sloping. Now see how sloppy your answering is, because many of you said when the yield curve is upward sloping. The yield curve, the expression yield curve is used in which asset class? 1 minute. What did you say? Finance.
Finance.
The expression, yeah, so that's the right answer. When I ask you, the expression yield curve is used in which asset class is it used? And that is, the answer is debt. The yield curve expression is only used in the asset class that we refer to as debt, not in equities, not in commodities. Okay? So therefore, when the question itself is asking you commodity markets, in commodity markets, these terms are only used in commodity markets. So if the question is asking you in commodity markets, what are contango and backwardation, why are people saying when the yield curve is upward sloping? The expression yield curve has no place in commodity markets. Okay, it's a debt market expression. Okay, so that's first case of sloppy answering. So that's not how it should be answered. In commodity markets, you can go back and read in your notes the definition. Again, the right way to answer this question is that what are contango and backwardation? When the term structure of forward stroke futures prices. You can look at either type of price, because remember, forwards and futures are very similar. Economically, they are very similar. So the correct answer is, that's why this question has 6 marks each. So the term structure is a key word that we are looking for. Term structure of forward and futures, forward stroke futures prices. Either of them could be referred to. Okay. So term structure of forward stroke futures prices, that's the second component of the answer. And the third component is, in the case of contango, you say it's upward sloping. And in this case of backwardation, you say it's downward sloping. This is how the answer should be given. Okay. And many people are saying upward sloping, so the price yield curve is upward sloping, so the prices are rising. How can prices be rising if yield curve is what? Terms no, any yield curve, or even if you refer to yield curve, okay, they use the expression yield curve, which is not correct in this context. But in any case, if it's a yield curve, what is it? Time series data or cross-sectional data? Cross-sectional data. So in cross-sectional data, how can you ever say that prices are rising? Prices are rising means it's like GABA is climbing up the stairs. I mean, there's movement. You take a snapshot at one point, you see it on stair 1. After a few minutes, you see it on stair 5. So when you talk, you should be aware of what you're saying. If a yield curve is cross-sectional data, how can you say prices are rising? You can never detect anything moving in cross-sectional data. It's only a snapshot at a point of time. Is this clear? Okay, so total disaster. The performance in CP is total disaster. Questions are very simple, very easy. It just shows that people are not paying attention. They're sitting in front and talking. Okay, so while I just try to drink some water, I have given you a link. Watch this video for a while. Copper prices actually. So maybe you can study this. I've given you a couple of video links. Okay, so what does this mean? Is this a supply deficit or is demand? What are they projecting going into the future? This kind of a thing shows you how fundamental analysis is done in commodities. Okay, so I've given you a couple of videos linked to in that sheet that we use as a daily tracker. Okay, session outline in that file. So this one snapshot in the beginning of this video. They're interviewing one of the metals company CEOs, okay? Because this LME, actually this is LME week in London right now, so if you look into the Bloomberg, you'll see lots of metals company CEOs being interviewed, okay? Because there's a LME week going on in London right now. Because London is a big center for metals trading also. Not just precious metals, but also what we call base metals, okay? LME is London Metal Exchange. So the LME is a London Metal Exchange, but right now it's actually currently owned by HKEX, which is Hong Kong Exchanges and Clearing. So the Hong Kong companies actually bought over this company, but they keep it as LME because the brand name remains. Okay, So this, what does this show? This is a deficit, or I mean, is supply going to exceed demand, or demand is going to exceed supply in the future, in 2024, 25?
Supply or
Demand is exceeding supply. What does the word say? Severe deficits. Severe deficits, which means essentially supply deficit. They are projecting a supply deficit. So if you look at the fundamental analysis, so one of the things that you're supposed to do in your project, one of the goals in the project is, why do we make you track these commodities? Because these are global commodities. Copper, oil, and what is the third one? Gold. Okay, all these are global commodities. Okay, so if you develop expertise in tracking these commodities, that is a skill that is valuable around the world. Okay, that has value around the world. So these are global commodities, and copper is very important for. It's a very cyclical commodity. It is tied to global growth cycles, etc. All right. So you can get from this kind of a picture, you can get a sense of. You have some idea about FA and TA, right? So you can get a sense of what kind of analysis people do when they do FA analysis. Okay, this is where FA basically. So this is where they're projecting the supply demand. So obviously they're going to come out with. So their view on copper is going to be what? Bullish or bearish? Bullish, right? Because they're projecting severe supply deficits. Okay, so excess demand. It's an excess demand situation. So they have fundamentals. If you listen to the discussion now, everybody's bullish. So you listen to this guy's interview. I'm not going to play it now anymore. I'm just going to put it into your into your sheet. Then there's also another interview with. I'll just explain that. All right. Okay, I think, okay, I'm just going to put this. So the other interview that you have, so I've given you the second link here. I'll just put a little line in between. Rio Tinto is have you guys heard of Rio Tinto? It's actually Anglo-Australian company. It's a very big, very old and big name in metals. Okay, it's a mining company. So this kind of magma resources case that you're doing, this could also be Rio Tinto. Okay, that's a typical kind of company that this case is based on. So you can listen to them talking about aluminium. This discussion is mostly on aluminium, so it doesn't really, but you still get a feel for how metals are discussed. Okay, what is the supply situation? You get a feel for this. Okay, so this is just for your reference. So you can listen to this. It'll give you a feel for what's going on in the markets. So where are we now? We have two. Yeah, what we're going to do now is we're going to go through the rest of the case. So we'll just quickly cover the rest of the material that is, we'll cover this technical note. We want to finish the technical note, the discussion. So this is where we were yesterday. This is like a taxonomy. Like if you see on that, if you look at that screen there on the top left, on the left hand side, the left hand wall. So that is your taxonomy of asset classes, markets, and instruments. Okay. So what you're seeing in front on the projector is this is a taxonomy of risk. Okay. So when you look at the different types of risk. These are the types of risks that you have. We've already discussed most of these things. Okay, so in most other taxonomies, you'll see most of these areas. This numbering system is not correct. Okay, so in most other, if you look at a book on risk management, you might find a similar taxonomy. The term that you may not find is a third one, financing risk. Sometimes people might leave out this type of risk, and sometimes they may refer to it as liquidity risk. So you'll hear some other taxonomy in which you might find this kind of thing as referred to as liquidity risk. So I've made it more specific and I've called it financing risk. Okay. So all this, if you're already familiar with most of this stuff, okay, So when we looked at that example, okay, so this example that we are looking at, when we look at this balance sheet and we are looking at any of these key risk factors, which is your gold, the gold price, the copper price, the West Texas, the dollar yen rate, the Aussie dollar rate, and as well as the 3-month LIBOR. Okay, when you are looking at the potential losses that this company might have, okay, the potential losses that this company might suffer as a consequence of changes in these rates. Okay, what you saw in the yesterday when we went to the ending balance sheet page, you saw that there was a big loss of $18 million. Okay, so that loss is entirely a manifestation of market risk. So we are still discussing the risk taxonomy. So you have market risk, credit risk, financing risk, legal, regulatory, and operational risk. So what you saw yesterday, the scenario analysis that we did, that when it went from a starting balance sheet net worth of 48 down to 30 something in this ending balance sheet, that is completely due to market risk, the manifestation of market risk. Okay, so if you have this balance sheet, you already have the risk. But when the risk actually materializes and you lose money, then you say that there is a manifestation of market risk or the materialization of market risk, okay, or any other type of risk. Is this clear to everyone? So market risk and credit risk are the two most important types of risks. I mean, most common, that is where most people lose a lot of money. Or operational risk also, you can lose very large sums of money. And but mainly we focus on the more technical discussions are on market risk and credit risk. Okay, measurement of market risk and credit risk. Okay, so when you look at market risk, so when you go back to that spreadsheet, on the left-hand wall, the taxonomy of asset classes, markets, and instruments. So when you are looking at market risk, typically what you're going to do is, the market risk is very complicated, okay? It's very complex when you're looking at a large bank or a large commodity trading company. Typically, you'll have a very complex structure of market risks. So the way to understand the way to do risk analysis for a large company is first to break down the risks into that taxonomy. Okay, so you break down the risks into, okay, these are the legal regulatory risks, these are the operational risks, okay, these are the credit risks, these are the market risks. And when you go into the market risk, first you apply the broad taxonomy of risk, and second, then you have to then marry this framework into the market risk. Okay, when you look at a further detailed examination of market risk, when you're doing a detailed examination of market risk, you have to look at this framework here, the asset classes, markets, and instruments framework.
This was going to get the market instrument and for the type of financial we are dealing in. Asset classes.
So you have to basically, so it's correct. So you have to then move on to, when you're doing a detailed examination of market risk, you have to then move on to this kind of a framework where you would look at market risk for each asset class. Okay, first you would look at a market risk for each asset class, and then within each asset class you would go market and instrument combination. So if you're looking at, let's say within market risk, you start looking at different asset classes. You start by looking at currency risk. Okay, you start by looking at currency risk, and then in currency risk you see that you have risk in dollar yen and Aussie dollars. Okay, so then you understand that your exposure is actually to the forward dollar yen rate, because the loan has to be repaid in the future. But for our trading purposes in the risk management project, we are going to treat it as the spot dollar yen, which will be rolled over regularly. But technically, in your project, if you look at your actual balance sheet that you're looking at, there you have two currencies where you have exposure to risk: Aussie dollar and yen. Okay. So what you have typically, how would you place it? First, you start by looking at currency risk within market risk, and then you see that it goes under currencies and it goes under forwards. Okay, so it is at the intersection of forwards and currencies. Okay, so you see that you have forward foreign exchange exposure and which are the markets within currencies where you have it is in Aussie dollar and dollar yen. Is this clear?
Yes.
Is everyone following how you look at market risk, how you do a risk analysis? Okay, and the same thing follows. So if you had if I could construct an even more complicated balance sheet. Now if we go back to this itself, when we go back to this itself, we can go back to this balance sheet. Alright, so on the currency side, if you look at the market risk on this balance sheet, so what we're doing right now is we are taking the theory that we learned about the proper taxonomy of risks, okay, and we also learned earlier the theory about the proper taxonomy of asset classes, markets and instruments, okay, which is on that wall there. So that we are marrying these two theoretical frameworks and we are applying it to this balance sheet and to understand how risk analysis would be done, okay. So if you have to give a risk report to the board, let's say if you're the risk manager or the treasurer of the company, and if you're giving a risk analysis report to the board, this is how you would present the report, okay? You would say, yeah, this would be the structure of the report, okay? So you would go by first the taxonomy of risks. You will say that this company faces these types of risks. Maybe you're currently trading with Iran, and then the US has imposed sanctions. So if you don't stop all your transactions, if you don't finish them by November, then you could face sanctions, okay, from the US Treasury. So that would be a legal risk, okay. So that's how you would lay out the presentation. First, classify all the large risk by applying that risk taxonomy framework, market risk, credit risk, etc. Then delve deeper into market risk by going by each asset class. And then looking at the market instrument combination. So in this case, when you go into currencies, yeah, so forward and the two markets. Okay, so that's the market instrument combination. Okay, so then you would say first we look at currency risk. We see we have dollar yen and Aussie dollar. So we have exposure to FX forwards rates for Aussie dollar and dollar yen. Okay, so it's a combination, crossing of currencies on the row side and forwards on the column side on that wall. Okay. You can't see, but you remember the framework. Like Chada there you can't read the things there, but you remember that framework, right? We have those. Okay. So then, what would you do further on this balance sheet when you're looking at further examination of market risk? You would look at this. Okay. Look at the commodity side. So then, once again, you come back to this framework. Then you zero in on the asset class that is called commodities. Okay. So you go to the commodities row. And then we are assuming that we will treat these as spot market exposures. So then it will be at the intersection of commodities and spot. Are you following this? Remember what I told you, that whenever you're looking at prices in any market, okay? Whenever you're looking at prices in any market, it will have to be the prices for one of these instruments. You cannot see any market price unless it is the price of one of these instruments. It will be either forwards, futures, whatever it is. Just like I showed you oil futures. I showed you the oil futures curve, okay? There you're looking at oil market prices, but those are all futures prices, okay? They are not forward prices or they are not options prices. They're all futures prices. So whenever you look at market prices, it's the price of some instrument or the other, okay? So the only instrument that is left out there in that framework is CFDs, okay? Which is what you're trading in your Rwanda platform. These are contracts for difference. Have I explained this before to you? Did I discuss this before with you? Okay, briefly I discussed it. Yeah, so contract for difference, Canada, France, Denmark, okay, CFD, okay. So contracts for difference I've left out. They are very similar to futures in that there is a daily mark to market and a daily settlement of profits and losses. The reason I've left it out from the framework is that CFDs are actually a retail instrument. Institutional traders don't use CFDs, okay, unless they're selling it to retail customers. So in the wholesale market, nobody trades CFDs. That is Bank of America trading with Citibank. They will not be trading in CFDs. Okay, what they trade is either futures or forwards. Okay, so because we are teaching you finance from an institutional perspective, so I've not prioritized CFDs, but technically you can read futures stroke CFDs. In that framework, you can read it as futures stroke CFD. Maybe I'll put a footnote later on. Okay, so CFDs are contracts for difference, and the Rwanda platform that you are using, when you trade these products, this crude oil, copper, etc., what you're going to trade in your project, you are actually going to be trading in CFDs. Okay, that's the instrument you are using because this is a retail platform. Rwanda is a retail platform. Okay, So you're actually going to be using CFDs, but it's exactly the same as futures. There is daily mark-to-market settlement of profit and loss every day, and it's just there is some, you see that there's a financing charge involved. Okay. So in this case, what we would say is that your exposure is for all these three commodities. So when we're doing a risk analysis or a risk presentation, we will say that as far as commodities is concerned, as we move through the asset classes, as far as commodities is concerned, commodities are concerned. So we will say that we have exposure in gold. We are exposed to spot prices in gold, copper, and oil. And then you would explain all these underlying positions. You would say that in all these cases, you would have to, even in the previous case where I forgot to mention that when you're discussing the dollar yen and Aussie dollar exposure, you would also mention the underlying exposure. Okay, so you would say that we are long or short Aussie dollars or long or short dollar yen. So here again, in the commodities case, you will say that we are exposed to spot prices in gold, copper, and West Texas oil, and our underlying positions in all these is long. Okay, this is how we would explain the risks on this balance sheet. Okay, and then when you come to interest, when you come to 3-month dollar LIBOR, what asset class is that? Debt. Okay, so that is debt. So then you move on back in the framework. You move down to debt. You can't see that debt here because it's covered. It's underneath. Okay, so then you move on to this framework and say that okay, in debt,
this risk is not manageable in Oanda.
In Oanda, you can't manage this risk, but in real life, when you are facing a situation, you will have a platform to manage this risk. Okay, you will be trading in a platform using like TWS or something where you can manage this risk. Okay, is everyone following so far? Okay, so then you would say that you move on to the asset class that is called debt, and you say that within that debt asset class we have exposure to 3-month US dollar LIBOR. Okay, and we are short. Our underlying position is short. Okay, so we will lose money if 3-month dollar LIBOR rises. Okay, is everything clear now? Is this clear now? How you would apply both the taxonomy that you learned earlier with respect to asset classes? Okay, and also this risk taxonomy that you've seen just now. Is this clear how this can be used in a real life situation? When you make a presentation, like a CFO is making a presentation to the board on the risks facing the company. Is this clear? Okay. And then of course you will talk further about what is your plan for managing the risk, etc. What are your views on the current market? Okay, so here I've introduced a new term, okay, which is new for you guys, and I've developed a little bit of taxonomy with, so it sounds very complicated, but it's actually simpler than it sounds, okay? Let's start with an example so that maybe it's easier for you to understand, instead of looking at the theory. Now this is what the term we are discussing is a risk book, okay? So if you look into if you walk into any trading room, okay, or a corporate treasury, people will be familiar with this expression called a risk book. Okay, so typically when you're actually interviewing for a job, people may not ask you at a job interview stage, but later on in life when you're trying to switch jobs or something, people might ask you, what kind of role are you? What kind of role do you prefer? Do you want to run a risk book, or do you want to be in sales? Okay, or do you want to be in operations, etc. So if you're running a risk book, means you're going to be very comfortable with changes in market prices. It's a trading kind of job. Okay, if you're running a risk book, means you will be responsible. Okay, so if you're running a risk book here, let's say you're responsible for the market risk on this balance sheet. Okay, if you're being made responsible, that means you are running this risk book now. That means whatever losses happen on this book, that is your problem. Okay, and whatever hedging you have, then you'll have the freedom to do take your hedge positions to try and offset these losses. But even on that hedge book, if there's any profits and losses, all is attributed to you. All of that is attributed to you. That's the meaning of saying that you're running this risk book. Okay, and what a risk book typically is, a risk book has market risk and credit risk. We don't normally think of operational risk as being part of a risk book. Okay, so typically on a risk book, risk book is basically nothing but a balance sheet. Any balance sheet which has exposure to key risk factors, which are basically which represent market risk. Okay, on this balance sheet you have all these key risk factors: the gold price, the copper price, the spot copper price, the spot prices for gold, copper, oil, forward prices for dollar, yen, Aussie dollars. Okay, so these are all key risk factors which can actually cause losses on this balance sheet. So this is an example of a risk book. Okay, so you'll get a little more familiar with this term, but I'm just using this term. So this is quite widely used in industry to refer to any kind of it's like a book. Where else we use the book? Just like I think we've used the expression before once in discussions. But this is what we mean in a finance, in a trading kind of situation, in a treasury capital market situation. If we say risk book means that there is a book, okay, there is a P&L, okay, and there is somebody responsible for that P&L, okay. So that's why people will ask you, is this the kind of job you want to do? Because they'll be very comfortable with having to take losses, okay. Market prices will move like what you've seen in your project. That prices move, you can't really figure out what is going on, okay. Prices move. You thought that the fundamentals were good, you bought the stock, but it starts falling, then what are you going to do about it? Okay? Are you going to cut your losses? So these kind of decisions, if you're comfortable dealing with these kind of decisions on a daily basis, then you're comfortable running a risk book. Okay? So obviously you can enjoy the upside also if you make money. Alright? So this is what it means. So this is a risk book, that is a term that is used in industry. I've just added a little distinction further on this. Okay? Let's just go through the. So all of you guys, let's say to understand this better, all of you guys, when you ran your project accounts, you saw what was happening in your project accounts, because every day you had to calculate the NAV, you had to note the NAV every day. So your NAV is changing, okay? So this stuff that is happening to your book, all of these things, accounts that you were running, these are all risk books, okay? Because you are taking positions, those are losing money or making money, the value of your portfolio is changing every day. So that's what you did in your first NSE trading project, the equity trading project. You were all running risk books. Okay, those are all examples of risk books. Okay, so that's what you were doing there. So it's I think hopefully from this specific examples you get an idea. And then here I've written a lot of theory, so you might find it confusing, but this is essentially what it is. Okay, so I've distinguished a risk book from a riskless book. Okay. Now notice that this expression is not normally used in the market. I have only used this riskless expression just to make the distinction or mark the distinction between risk books and riskless books. Okay, just to make you understand what is a riskless book, so that you can understand what a risk book is better. But don't use this expression riskless book, because people don't use the expression. Okay, so essentially it's a balance sheet where assets or liabilities don't change easily. Frequently in value. Okay, so you could actually have a balance sheet. Let's say if you have there's a company called Westinghouse Electric which manufactures nuclear plants. Okay, so maybe now obviously the value of a nuclear plant does not change on a regular basis, unlike the gold price or the oil price. So these are changing almost minute to minute, okay, or second to second. So nuclear plant value also changes. Maybe after 5-7 years you feel that plant is no longer, the technology is old, or so it changes very slowly. So those kind of things we don't consider as risk books. Okay, so the idea behind a risk book is the balance sheet where the assets and liabilities, the value of those assets and liabilities can change very frequently. Where those, the prices are from markets which trade actively, like copper, gold, dollar, yen, these kind of things. Okay. LME, it could be LME as well. So if you look at Rio Tinto's balance sheet, that will be a risk book, because they will have a lot of inventory of metals, aluminium, copper, iron ore. All these kinds of things are fairly actively traded. Iron ore is not as actively traded as copper, okay, or oil, but it is still fairly actively traded, so it will be treated as a risk book. Okay. Okay. This is what I've said. I've highlighted the key parts, and mainly in risk books we are concerned with market risk and credit risk. Okay. Now I've made another distinction. Okay. Another thing to understand is what?
Active versus passive risk.
Yeah, active versus passive risk books. Okay, now this is a distinction that I've made just for you to understand this distinction, to understand that there are actually qualitative differences. Now think about what you were doing in your first term, in your earlier equity trading project. You started out with $1 million in cash, okay? So there was no obligation. Some of the groups just cut marks for Jayan's team. Write down Jayan. Major conversations going on. Okay. All right. So in what were you doing? You had $1 million in cash. Now nobody was penalized if they did not start trading on day one. Some teams waited for a while. Some teams started trading immediately. Okay. So that's your discretion. You may feel that if I don't have a good trading idea right now, I'll just wait and watch the market. Okay. So this is basically when you start out. Now this is an example of, so the book that you were running, do you think it was a speculator's book or a hedger's book? It's a speculator's book because your first transaction will increase the risk because you started with $1 million in your bank, in your brokerage account. There is no risk. In that position, there is no risk because you just have $1 million lying in cash. That cannot change in value. Dollars to dollars, cash cannot change in value. So that's not a risk book. So you started with another way of looking at a speculator, the definition of a speculator. Another way of looking at that idea is that you start with a book which has no risk. Because you start with a pool of funds and there's no risk in that, okay? If you don't do a currency conversion, then if you gather money from Japanese investors and then convert that money into dollars, then of course you have created a currency position. But if you are in the local currency, then there's no risk to start with, okay? But then immediately you started trading, you start buying and selling stocks, now you create risk positions, okay? So now you can lose money, now your balance sheet can fluctuate in value. That's what you saw happening in your NAV, right? So that's an active risk book, where essentially an active risk book is one run by a speculator, okay? So okay, it just cut marks for Nagpal also. I don't know why Nagpal and both Nagpal and Ayush are grinning away constantly. Okay, just cut for Nagpal as well. Why don't you sit separately? All you guys, every day you guys lose marks. You go and sit separately, sit next to someone you don't like, so you'll never talk to them. So that then you can at least save marks for your team. Okay. So the term that we are introducing, okay, which is not used in the market, but you can make, it's important to understand the distinction that there are two types of risk books. There are active risk books and passive risk books. Active risk books are run by speculators. Okay, so there is a qualitative difference. That's why I've introduced this terminology to highlight this difference. That in a case, what you did in your NSE trading project, you started with a book which had no risk, just $1 million in cash. Then you actively took some decisions, okay, to buy and sell some stocks, and that's why you started creating risk positions. So this is an active risk book which is run by a speculator. It starts with no risk and then it starts increasing its risk. Okay, is this clear? Okay. Now we have a second category, which is the passive risk book. I've actually started defining passive risk books in the notes first, but anyway, in our discussion. So passive risk book is what you see in the case of this Magma Resources balance sheet. Okay. Now this company is not in the business actually of, I don't know if you've heard this idea before in M&A. Have you heard this idea that you're trying to, the main reason for operating companies is to basically extract the efficiencies from the value chain?
Yes.
All these ideas you've heard?
Yes.
Okay. So there is an important train of thought, which is I think a fairly reasonable view, that let's say a commodity company, a mining company, like a resources company like Rio Tinto, okay, or what we have shown here in Magma Resources. They are not in the business of speculating on commodity prices. Okay, if you wanted to speculate on commodity prices, there's an easier way to do it. Open an account with Oanda or IB and trade in futures. It's much simpler. You don't have to go and open a mine in Peru and deal with all the union problems and all these other problems. There'll be some strike at some port somewhere, then you can't ship out your copper cathodes. Okay, all kinds of headaches that you have to deal with when you're actually running a business, right? Why bother with all that? If you just want to speculate on copper prices, just open a futures trading account and buy and sell. It's so much simpler, right? Much more efficient. Are you following the logic? So those companies which are in businesses of like this Magma Resources, which is in the business of mining all these commodities or exploring and exploring oil, okay? Exploration and production, exploring and producing oil. So these kinds of companies, they are not actually in the business of speculating on these commodity prices, because that can be done much better, much more efficiently by just opening a commodity trading account. What their business is, they are just trying to extract the efficiencies in the value chain. That is, you go open up, how do you deal with the Peruvian government, okay? Opening up, get permissions to run, I should have said Chile, not Peru. Okay, so Chile is the world's biggest copper producer. Okay, there's a company there called Codelco, which is the world's biggest copper producer. It's a Chilean copper company. So, so what you do is, this is what the expertise is of a mining company. They know how to deal with the government, get the environmental permits, open the mine, run the mine, extract the copper, then deal with the unions and all the labor problems and shipment and this and that. So this is why they're in that business. They're not in the business of speculating on copper prices. Okay? So they really don't want to be speculating on copper prices. So here, this is what we say. This is an example of a passive risk book. But at the same time, although they are not interested in speculating on copper prices, what are they talking about here? Okay. So we know now that Magma Resources, as a mining natural resources company, not interested in speculating on copper prices. But are they exposed to copper prices?
Yes.
They are exposed to copper prices. So what is happening in this case is, by virtue of the business they're in, they end up being exposed to copper prices, risk of copper price movements, okay, or adverse copper price movements. Okay, so this is the idea in a passive risk book. You see how it is qualitatively different from a active risk book? Because nobody told you to go and speculate on NSE stock prices. You could have just coolly taken that $1 million and put it in a bank FD and earned that interest risk-free. No market risk on an FD, because the interest rate is told to you beforehand. You know that you are getting 9% for 1 year. You could have just taken that $1 million and put it in the bank fixed deposit and just went and gone on holiday. But what did you choose to do? You chose to take that book which had no risk, and you started buying and selling NSE stocks, and thereby creating risk on your portfolio. So that's an active risk book. Okay? So that's a speculator's active risk book. And what is happening in the case of Magma Resources? They don't want to be speculating on copper prices, but they think that they are very good at mining and selling copper, physical copper, okay, and dealing with all the associated problems. So, but because they are in the business of mining copper, and copper prices move very frequently, okay, and what the prices at which they are going to sell their copper to their customers, those are going to be determined by copper futures prices on international markets. Okay, so those customers are going to refer to those futures prices on international markets and agree to buy and sell at those prices. So therefore, by virtue of the business that they have chosen to be in, okay, by virtue of that business, they end up being exposed to market risk. This is clear, market risk and credit risk. So by virtue of the business, they are exposed, so that's why we call this a passive risk book. So can you see a difference between qualitative difference between active risk books and passive risk books? So that's why I brought out this distinction. So when you're discussing this idea in the market with someone, you have to explain the distinction also, okay, because they will not be familiar with these terms. But you can explain that there is a qualitative difference between a hedger and a
indirectly exposed to risk.
Yeah, you can say that also, directly or indirectly exposed, but you have to explain that further, okay. So a passive risk book is basically that which belongs to hedgers, okay. A hedger basically will have a passive risk book. Is this clear? Okay, this is all basically that is mentioned in your notes here. So all this stuff you can read. I already explained this. So there's a lot of writing here. That's because I want to make sure that whoever is reading it, if he's understanding it only from this writing, he should be able to understand it clearly. Okay? So all this material has already been explored. Now you read it. If you don't understand something, then you ask me. Okay, so I've already, again I've compared one previous unit of learning that you had, one previous module. What are the types of players in financial markets? These are all topics. Remember guys, for your interviews, these are all topics. So you remember little modular topics. So one of the things, this is a very small topic actually. So what did you learn about? We learned about different types of players in markets and what are their characteristics. This is also a topic. Okay. So this is all these things that you have to remember. You have to be ready with your topics, and if they ask you this question, if they give you a penalty kick in the interview, then you should be able to score the goal, right? Okay. So this is the difference, that hedgers have run passive risk books and market makers and these guys run active risk books. Yes, people are getting restless. Is it already near time? But Aryan's alarm has not gone off. So don't worry. Sorry? 1 minute. I don't owe you anything. Okay, so the question that Tushar, you asked a question about those option price strategies. What I suggest you do is read that CME booklet. Remember in the previous course I've given you a folder, a finance reference. In that there is a booklet from the CME, 25 option strategies. If you read that booklet, then you can understand the article a little better. I don't want to discuss it right now because there is option trading that will interrupt the flow of what I'm covering. Okay? But if you read that, you'll understand. So we'll wait for Aryan Salam. Oh, there's a lot of time. Okay, we have to cover a lot of material because there's a huge amount of material to be covered, and I'm afraid again we will not have time to cover all this. There's so much material to be. Actually, we need about 5 to 6 courses. Instead of that, we are doing 3. Okay, so this stuff I'm not covering because we already understood this now. Okay, UP, UE, you already know what it is. What have I said here about passive? Okay, all that has been discussed already. How to figure out what the underlying position is, key risk factors. Okay, now here we are answering the first question in the case as well. Okay. Yeah. So if you go back to the question, the first question in the case, guys, what are the key risk factors? Okay, the key risk factors are just nothing but specific prices of market instrument combination, specific market prices that you refer to, which are the source of risk for that book. Okay, what are the sources of risk for this balance sheet? Okay, those specific risks from this balance sheet, they arise from the gold price. Okay, from being exposed to the gold price, the copper price, the oil price. So on this balance sheet, you say what are the key risk factors? Here you say the spot gold price, okay, the spot copper price, oil price, spot oil price, okay. Then you say forward dollar yen exchange rate, okay. Then Aussie dollar, forward Aussie dollar exchange rate. Then here you say 3-month US dollar LIBOR. Okay, these are the key risk factors. Why do we say key risk factors? Because so this is the first thing you do when you're looking at a balance sheet, when you're analyzing a balance sheet, okay, to understand the risks on that balance sheet. This is the framework that you apply. First, you identify all the key risk factors. Okay, if you saw that this company had aluminium inventory as well, then aluminium prices would also be added as a key risk factor. Okay, this is how it would. So this is all that it means. So we are just learning some terms. Okay, these are specific terms that you can use. And what this means obviously is that these are the factors that drive the risk of this balance sheet. Okay, so that's what it means. And then key risk factor market is just another term, which is when you say gold price is a key risk factor, then you say the international spot gold market, okay, which is an OTC market, that's the key risk factor market. That's the market that you have to follow. The key risk factor market is the market that you have to follow in order to form your views and then take hedging decisions. Yeah.
How can we deduce from this balance sheet that it is a spot market or what?
No, that will be given. That information will be given in the case. This question is how can we deduce from this balance sheet whether it will be spot market or forward market? That information will be given in the case. Like what I'm going to do is I'm going to rewrite the case to remove the problem of interest, because we have said that I've said in row number 4. I said ignore liabilities represented by future interest outflows. I might actually remove that, and then I'll make these 2 zero coupon bonds. These yen loan and the Aussie loan, they will be zero coupon bonds, so there's no interest liability. There's a bullet repayment of principal at the end. Okay, at 5 years, after 5 years. So you're just looking at a lump sum principal payment. Okay, at the end of 5 years in yen of 1.5 billion yen, and then in Aussie dollars of 20 million Aussie dollars. Okay, that's the amount that you paid. Obviously, so the disbursement that you got is much less. Okay, so let's quickly go through the notes. So this is what is meant by the key risk factor market. Okay, which is the market that you have to track in order to manage your risk. Okay, this is also answered. This is also being discussed with you guys. Hedge transaction, hedge position. You have to be very careful. Like what we saw in the CP performance today, very sloppy use of language. Discussing commodity markets and using expressions like yield curve. This is not acceptable, okay? So very particular use of language. Transaction means purchase and sale. Position means long or short. Position can be only long or short, okay? Be particular about, although in industry you will find that people are not that particular about the use of words. But that doesn't mean that you should also be sloppy. You should, for your own conceptual clarity, you should maintain good habits, right? What does it say here? Okay, this part here, what it's talking about is, don't look at your watches, the alarm will go off, don't worry. Here, what is it talking about? It's just reinforcing the idea of offset. Here, what does it say here? Offset. That the hedge position should be, the hedge transaction should be such that the hedge position will offset the underlying position. Okay, so whenever you think of hedge positions or hedging, think of offsets. Hedging is another term, especially in India. You see people are using hedging left, right, and center. Loosely using all these terms. So be very careful about what exactly hedging is. Let's see if there's anything else. Okay, this is just showing you how the hedge position will neutralize the movement, the net effect on the portfolio. Okay, because the hedge position will show the exact opposite performance of the underlying position. So it will offset and then it will neutralize the effect on the portfolio. Okay, another thing to note this. Remember what we showed you, those two terminal levels at Changi, level 1 and level 2. So hedge position and underlying position is running as parallel. The hedge position is like sitting on top of the underlying position. So when you close out the underlying position, that is not hedging. Okay? If your underlying position in crude oil, instead of having 1 million barrels, maybe you make a sale of 500,000 barrels to a customer. So your underlying position has already gone down by 500,000 barrels. Now what you say is you have closed out 500,000 barrels of the underlying position. You do not say that you have hedged. Is this clear? Again, important to be careful about the use of term. People use all this hedging and all very casually used here and there. Do not use words casually. Terms have specific meanings. So if you sell the physical oil, 500,000 barrels, you have closed out the position to the extent of 500,000 barrels. You have not hedged it. Okay, hedging means you will have that two-level setup. You have a parallel book running. Okay? Sorry?
So selling the barrels is squaring of position.
Hedging the what?
So selling those barrels, 500,000 barrels.
Yeah. If you sell the physical underlying position, that is called squaring the position. Okay? That is called squaring the position. Why are you standing up, Giri? Sit down. When the alarm goes up, then only you stand up. Next time you do that, I'll deduct marks for your team. But the class is over only when I declare that it's over. Okay, alright. Last paragraph here. Remember what we refer to as basis risk?
Yes, sir.
Okay? When the airline has underlying exposure in jet fuel but chooses to hedge in crude oil using crude oil futures. So they haven't eliminated their entire risk. They have eliminated their outright position risk in jet fuel. But they have ended up with spread position risk or a differential position risk. Okay, that's your alarm. Okay, now you can go. I thought that was somebody's phone ringing.
Nagpal and Jayant, Ayush's group and Nagpal from Akamsha's group.
One minute. Nagpal is Akamsha's group. -8. Okay. Jayant is Ayushi.
Please check that.
-4.
Yes.
Okay. Only these two. Who else had a question? Anybody else with a question? Tushar's question I've already answered. Who else had a question? Nobody else? No other question. So you read that booklet first.
This article today in the morning.
Yeah, but you read that CME booklet. And what is the problem? I've closed that file now. That 12th of September or 12th of whatever it was. What? Yours is not adjusted.
just I can't.
That's okay. No, you don't have an A. That formula counts only A's. Orange color because they were not physically present. It doesn't matter. It's not going to affect your score. Your score is affected only when you have A. If you want some other color, I'll change the color. I'll give you some other color. Yeah.
Is it possible to know the marks for the intern that we had for the
IPM.
Yes.
You still haven't got the marks.
Sir, we have only got the final grade.
Oh, you want a breakdown? Okay, I'll give you the breakdown. I'll send you the breakdown. Now that Lalita has given you the marks, no?
Yeah, Shoma has mailed us
The end result, no? So now I can give you the breakdown because they didn't want me to release the breakdown earlier or the grades earlier. Okay, I'll send it to you. I'll just place it in your drive, in your folder, in the IPM folder.
मैंने नहीं दिया था, मेरा अपने आप आ गया। एक्टिव मेंबर भी बन गई
Arias, just do me a favor. Just shut the notification. I think just switch off the, you know the off switch.
Yes, sir.
There's two steps. You have to press enter. Yeah.
So you have collected the marks for HR conclave. We have not an minus can करे आपने?
Oh, new marks for HR conclave. Okay, I have to check that. Because my grades, that message came. Are you sure, Arihant? That message came. Are you sure you want to shut down? Yes, no. No, you have to press second from left. Top left. Second from left. Then you'll get. Now you press enter. Now press enter. And now it's done. Okay.
Where should I keep this?
I'll just keep it there.
Be careful with the
Yeah. Okay, guys, I hope you're not having lunch here. Double A. I hope you're not having lunch here. You don't eat here. Okay, you can hang around for a while till Rajesh closes it. You got F in IPM. I thought only Akshat Gupta got F. Just hold
जो करते हैं
एनालिटिक्स की कंपनी या आईटी मैंने पल्लवी को भी बोल दिया इतने enthusiastic थे काम करने के लिए सबसे पहले मैंने environment डाला सिर्फ भाग करके एयरपोर्ट सेट कर देना फाइनेंस वालों को पाइथन का ट्रेनर भी फाइनेंस का
Nikhil is here.
बेसिक करवाती है मार्केटिंग करें I know it's an ongoing process.